Where do you go live if you're about to make a lot of money but you don't want to pay a lot of taxes? Well, my guest on today's show, Mr. Jack Krupey, a former Northeast native, now Puerto Rican citizen, is going to share why Puerto Rico has some very, very favorable tax laws, especially for those who are in business, real estate, fund managing, crypto, and why there's such a rapid growing community of folks who are moving to Puerto Rico to live, to work, to play. This was a very, very good, fun conversation with my friend Jack, and just hearing his strategy and what he's doing from a tax perspective and how that's helping him in his business as a fund manager there in Puerto Rico. But then also what Jack sees is kind of the landscape of real estate and what him and his company are investing in this year. I think you're going to really enjoy this show. Let's get into it. Jack, welcome to the show, man.
Great to be here. Thanks for having me.
Dude, so are we recording this I'm not in Puerto Rico, but we got to live in two of the best places to be a real estate investor, right? San Diego and Puerto Rico. But you don't look very Puerto Rican, man. What are you doing down
there? Yeah, no, I'm originally from New Jersey and lived in New York City for a number of years before I moved down here. And yeah, don't quite have the suntan for Puerto Rico yet.
Not yet, man. They must have some good sunscreen down there, dude, because you don't look like you've been sitting in the sun very much. Still,
yeah. And then half the time I'm working during the day, so it's I'm not retired yet, so I'm not at the beach all day.
Well, man, I'm excited about the show. We're going to talk about living in Puerto Rico, kind of the benefits, why you moved down there. But, Jack, you got an interesting story because you're originally from New Jersey, New York area. And so before we get into kind of why Puerto Rico and the tax benefits and everything that's beautiful about living in Puerto Rico, take us back a little bit, man, in your journey, because I want to know what really was the big motivation to go there. So take us back a little bit, kind of your investing journey and really what led to this.
I've been through a couple crashes already, and I graduated college during the dot-com crash of 2001. So I had thought I was going to go more into, computer networking, engineering type of work in the IT industry. And I went to college in Rochester, New York. And during that time, I had a job, but it wasn't what I thought the dot-com was going to be. I thought I was going to be, working in Silicon Valley or New York City, doing something amazing. And I was, just in a basic computer job. So my college landlord was a real estate broker, owned about 20 single family and 2 family houses. And I went to Las Vegas for my 21st birthday and saw all the glitz and the glamour and the money. And I came back to Rochester and I was like, I got to do something bigger with my life. And I bought a paperback book on my flight home on how to make money in real estate. I talked to my landlord. I'm all excited. And this being 2001, 2002, this was the beginning of the first real estate boom. And 2 weeks later, I owned a 2 family house, almost no money down. And another few months later, we found a VA assumable loan that anyone could assume. And I think I paid $400 out of pocket for that closing. Wow. So pretty quickly, I was in the real estate business. And within a year, I quit my job and I was brokering, wholesaling, doing all the traditional retail kind of, real estate, the things you'd see on the infomercials and the things that most of the entry-level real estate investors do. 2008 happened, and I was through the second crisis I've been through. Like a lot of people, I took a few lumps, and fortunately, where I was in Rochester, it wasn't as much of a boom bust market as California or Phoenix was at that time. But things really froze up, and I had to kind of figure out what the next step was going to be. So I moved back down to New York City, and in November 2008, I was on Wall Street working for a private equity fund that was buying non-performing mortgages. So, it's an important lesson about, needing to pivot. A lot of people kind of got into real estate after 2008 and sort of haven't lived through that first, that real estate crash. It's still those lessons as I've pivoted over my career are burned into me.
Right. Yeah. You saw, so it's interesting. You saw both. You started buying non-performing mortgage notes. Probably a good time to be doing that. You found yourself in probably a pretty lucrative position. So 2008 hits. And kind of walk us through, these next, I guess briefly, because I want to get to the point of kind of where, the decisions you've made now and talk about Puerto Rico, but it seemed like a real turning point for you. Kind of accelerate us through this journey and what began to transpire for you.
Yeah. So it was definitely a crazy time, and somewhat of the right place and right time. These private equity funds needed real estate people. They were taking on thousands of non-performing mortgages, and they needed people who knew how to do short sales,
Right.
knew how to liquidate foreclosures, but they needed them on the banking side to make sure that as offers come in, that we knew how to run the comparables, and that we knew how to make sure they weren't getting properties, letting them go for too cheap, and just or getting the best execution on them. So was at a fund for about 2 years, and then I left, and then I partnered with a family office, and really backed into large private equity in New York. I'm just a guy from New Jersey who was in 2002 or three started buying two-family houses and flipping properties, and all of a sudden we're partnered with a private equity fund, and we bought over $3 billion worth of loans. These were a combination of performing and non-performing loans nationwide. At any given moment, we had over 600 foreclosed houses that we were responsible for either fixing up or liquidating, and got really good at learning pretty much every market in the country. And you could pretty much drop us anywhere, a property in almost any city, and within a few minutes, we'll know what the value is, what the after repair value is. We built a really good network of agents and property preservation. So it was an amazing ride. Learned a lot, but it turned into a job. It turned into I've described it as corporate hell from time to time. And I worked with great people who were incredibly smart and hardworking, but when you're an entrepreneur, you're cut from a certain cloth. And when you're working the kind of Wall Street, New York culture of being chained to your desk and sort of just being in the office every single day with minimal flexibility, it starts to eat at you. And that's what led to some of the decisions to move to Puerto Rico. On top of that, the tax rate in New York, New York and California are both approaching 50% or a little over 50% at the top brackets. So when you look at how you're spending your time and how much money you actually keep, when you're in that W-2 plus bonus type of work that unfortunately a lot of finance and tech people find themselves in, that there's got to be a better way. And that's what
right. It's like a double-edged sword. I feel like, man, it's like, you work hard in the long hours to be able to afford the city. But the reason, it's like, what I'm saying? But living in the city means you have to work long and hard hours, right?
Yeah.
Like it's this double-edged sword of, kind of this never-ending cycle of, where you live means the longer you have to work, the harder you have to work, and you're kind of trading that for, it really is, you're making that conscious decision, which I found that really interesting. So it seems like you found a way to kind of get off of this cycle.
Yeah. It was a few years in the making. I knew a few people who moved down in 2014 or 2015 to Puerto Rico. Puerto Rico enacted some tax incentives to recruit people to the island. They started it as early as 2012. And at the time, it was called Act 20 and Act 22. They've since consolidated everything under an act called Act 60. What it is Puerto Rico had been in a recession for over a decade, and the population was actually declining. Puerto Ricans are full U.S. citizens and are able to move to the mainland and work. So the tax base was declining, and the government got together and wanted to create some incentives for business owners and entrepreneurs to move to the island. So one of the acts that at the time was called Act 20 that I took advantage of is called the Export Services Act. And so fund managers, internet marketers, really anyone who's making money off island that moves to the island is only charged 4% tax. And there's no federal income tax when you're a bona fide resident of Puerto Rico. So if you live here more than half the year and pass what I'd call the closer connection test, I'll often get questions on, can I just hop on an airplane 4 days a week? Stay here 1 minute and go home? That's not going to work. You actually have to move here. And most of us who've moved here, become part of the community. There's a great community. We've made a lot of friends. There's, thousands of people who've moved here in the last few years as well. So
4% tax, meaning, and no federal income tax. So every dollar you claim as income, you're essentially only paying 4% on that, and then no federal income tax. So really, it's just 4%. I mean, it's kind of the fee of whatever you call your salary.
Exactly, exactly. With that said, you're supposed to pay yourself a small salary, which I do. So it's, it may end up 6%, but when you're going from 50% in New York or California, it's a massive, massive discount.
Yeah,
Uh,
that's huge.
so it's roughly 4%, 4% with a rounding error here or there for a few other fees. The other thing is there's no short-term or long-term capital gains.
Wow.
So there's a lot of stock traders, a lot of cryptocurrency owners and traders here. The short-term capital gains is especially lucrative for those who trade actively or who trade options, because if you buy or sell a stock in less than a year, it's typically going to be taxed at ordinary income.
Right, which in New York is 50% at the highest tax bracket.
Exactly. Meanwhile, here it's completely tax-free. And for me, I'm not an active trader, but if I'm here for 20 years, just anything I have in the market that's able to compound and grow without the fear of having to pay taxes of just selling an individual stock that I want to reposition or even rebalancing the portfolio. So it's very lucrative even for those who are not really active traders.
Yeah, and just for our listeners who maybe aren't familiar with the tax bracket, but are making a lot of money or have a lot of money in equity. I mean, even in long-term capital gains, depending on your tax bracket, it's going to be anywhere from 20 to 25%, maybe lower, maybe 15%, depending. So, what Jack is saying is that there is no long-term or short-term capital gains tax. So, you're going to be able to collect all of that. And so I want to ask you, Jack, like I got a couple buddies, well, let's say we're real estate investors, right? But let's say we're selling a deal, or I have a couple buddies who are selling businesses, this year. They've made a good run. They're getting ready to sell a business. I mean, do you see guys moving there to kind of position themselves for an exit? Let's say we're exiting a big deal, we're exiting a company, and then they're kind of positioning themselves to sell and then plan to move back. Or once people move there, most folks are kind of settling there. Walk me through, or walk our audience through a strategy, especially if you're in that position where you're foreseeing a big sell, what you're seeing on the island, man, and how folks are kind of really, really utilizing the tax laws there to plan ahead.
Sure. So first things first is you absolutely have to plan ahead. If you're selling your business next week, hopping on a plane to Puerto Rico is not gonna cut it. It takes in some cases a few years of planning. I actually moved 2 years before I ultimately was bought out of a firm in New York. So it takes a lot of planning, and it's going to take a professional. If you have an active business, especially if you have a business that's a 7-figure business already, you're going to be spending some time with accountants and attorneys to make sure it's done right. There are things like a transfer pricing study to look at what the value of the business is when you move to Puerto Rico, and in some cases you may actually want to pay some tax when you move to basically sell your business to your Puerto Rico business to start clean. That's similar to the situation I was in. In other cases, you may have a business that's still going to have some operations in the mainland. And if that's the case, then there's things like setting up a branch office in Puerto Rico, and also factoring in what income is really sourced to the US versus what is sourced to Puerto Rico. So just being here doesn't mean that everything is sourced here. If you have employees in the States, you do need to segment the income that's coming from operations in the States versus the income that's coming to Puerto Rico. And I know a number of friends down here that have, pretty large businesses with multiple offices, multiple employees that, have still saved a lot of money. But, the bigger you are and the more operations you have, it's not automatically 4% for everything, but it saves you significant amount of taxes, and the legitimate operations and work that you move to Puerto Rico, including your own time and your own, for some, even with smaller companies, it's your own consulting,
Right.
Will save you significant money, certainly pay for your move. And then with all the additional benefits, plus, living on an island paradise, it's, for many of us, it's been more than worth it.
Let me ask you this. So for the standard, let's say the standard, let me give you a scenario. One of our investors, let's say he's either got some big gains in crypto over the last 10 years or been in multifamily for the last 10 years and got some serious gains in their portfolio. And, over the next year to 2 years, going to begin to kind of exit some of this stuff. And instead of paying 20, likes the idea of paying 4%. How much time do they really need, and what would be kind of how should they think about if they're like, this sounds really interesting, what are some of the steps things to consider for them. Maybe they're not, they don't have a big business, but they have a portfolio of gains that they're looking to begin to kind of exit out of over the next year to
Sure.
3 years.
So there's two options for the crypto and the stock side of things. You can not sell, and then you start the clock in Puerto Rico, and you have to split the gains. And I'll add, I'm not an accountant or an attorney, so this is information that's
got it.
yeah. So I encourage everyone that this is not tax or legal
Yes,
advice.
right.
But yeah, it's from what I know of it is you could either, especially the market's been down the last couple of days. Theoretically, if you were moving next week, you could sell all your crypto and then buy it back in 2 days, and then you've reset your basis, and now everything in Puerto Rico is tracked there. If you bought Bitcoin at $500 a coin and it's sitting at 30,000 and you don't want to sell, you can move to Puerto Rico and then just work with an account, and you will track the future gains. So
it's really based on when you move to moving forward. Like you would still have to pay normal tax capital gains on the gains before you moved, is your understanding?
Yes. And then there's a 10-year window. So if you're holding for 10 plus years, I believe there's kind of a wind down on eventually you can avoid the stateside, but otherwise you're splitting it. But if Bitcoin's down to, as we record this today, like 36,000, if you were to move down and then Bitcoin goes back up to 60 or 80,000 in a month or two, you could track those gains separately from once you're a bona fide resident. Multifamily is a different story. And this is something, I still own significant multifamily through syndications, similar to the deals you do right. In the mainland. Now, real estate is taxed where the property is. So real estate is going to be U.S. sourced income, regardless. The good thing about that for me in Puerto Rico is I have no other U.S. sourced income. So, I typically run a loss because of the K1 depreciation. So I'm at the lowest tax bracket, or if something does sell, one of the many buildings I'm in, if there's one sale and it was for an $80,000 gain, I believe it's 75 or 80,000. But if you've made no other U.S. income and your income for the year in capital gains is less than whether it's 75 or 80, it's actually tax free.
Wow.
And by structuring it right, even if you have a few sales one year, if you have no other income, no W-2 income, and all you're doing is generally showing passive K1 losses, you're going to be at the lowest tax bracket in the States as well. You might be paying 10 or 15% instead of 37% or 50% by avoiding the state taxes and generally being in a lower federal tax bracket because your stateside income is mostly or all passive.
Two things I want to ask you about Puerto Rico, and I want to hear really more kind of your outlook on real estate investing, as you're working with a lot of accredited investors as well. The way you structure it, I remember you telling me because there's only a 4% income tax, some of the ways that you're setting up your funds. Would you be willing to speak to that for those who may be on the fund manager side or active side of putting deals together and the benefits you're receiving or the way you're structuring deals living there versus maybe I would do it here in the stateside?
Yeah, absolutely. So, as part of the Puerto Rico, the Export Services Act, which is now under Act 60, any management fees or income, essentially pretty much anything sourced from Puerto Rico that you might get a 1099 for, or that would be an expense to a U.S. company, is coming in at 4% in Puerto Rico. So for our fund, we charge our management fee, which is pretty standard. We actually charge a 1% management fee, and then we charge a 1% acquisition fee on our fund generally. And many syndication deals do a 70-30 split. And we advertise a 70-30 split, but in reality, what we did is we took half of that as fees instead of as carried interest, but it only triggers once we've returned all investor capital and paid all preferred returns. So it kicks in at the exact same time. So to a passive investor, it's the same. There's absolutely no disadvantage to them, but it's a way to split off some of the fees from Puerto Rico. And I also have a few stateside partners that are involved and help with the fund. So the other part of the carried interest goes to them on the mainland, in an efficient way for them, which is through the carried interest, which ideally for them is taxed at 20%, like a private equity or hedge fund manager.
Yeah, that's fascinating, man, to think that you're kind of doing the opposite there, which what would make sense here, because taking advantage of what are willing to take advantage of. And I can already hear my non-capitalist friends thinking, well, you guys are just skirting the tax law. And I would say, yes, we are, in the sense of we're taking advantage of what's been provided and given according to the rules. So I think in some ways, like you're living into the system which has been created, and so it makes a lot of sense.
Yeah, and you look. I mean, there was just a large federal stimulus to Puerto Rico. There was a significant hurricane back in 2017, and there's still, it's largely in most parts of the island recovered, but there's still some left over from that. There's still some infrastructure. There's a lot of a lot to do. So we're contributing to the tax base down here. It's money. I love Puerto Rico, but I didn't. It wasn't on my radar of places to move without the incentives. So it's really found money for the island. And additionally, I bought a condo, I bought a car, I spend probably an inappropriate amount of money at restaurants. And
Well, that was my last question, man. I remember you saying, or at least about Puerto Rico, you said, most people come here for the taxes and stay for the community. Dude, what is it actually like to live in Puerto Rico? Like, give me, what do you do? I mean, yeah, that's what I want to know, man. Like, are people going to have fun, or are they just actually coming there to save some money? Because money ain't that important, right? Like, it's also about lifestyle.
Exactly. Now, there's a couple different types of people that moved here. I mean, there's people who just move into the golf course communities with, families and kids that are a little more quiet. But, in Condado, where I am, which is, on the beach right in San Juan, I've heard someone describe it's sort of like freshman year of college for adults, because there's thousands of people who've all just moved here. And so it's a combination of I guess freshman year of college is kind of a joke, but also a little bit of Silicon Valley, a little bit of New York. There's an amazing crypto scene here. So, personally and professionally, to meet people, someone new to an island who's, over 40 years old, it's amazingly easy. And the caliber of talent has been incredible. On the social side, there's groups for beach volleyball, there's groups for hiking. We have the only rainforest in U.S. territories outside of Hawaii, Oyunque rainforest here in Puerto Rico. There's tons of beaches. There's culture. The locals are generally super friendly. There's a few that are not as happy about the tax incentives, or that think we're driving real estate prices up. But pretty much anyone I've ever interacted with has been happy to see us, and and happy we're part of the community. There's a lot of charity. There's actually Acts 2022 Society, which donates tons of money to charity. And I know many of my colleagues and friends here, have found charities that they contribute to down here as well.
Right. So, dude, let's talk about kind of your outlook on the real estate space right now. So you're essentially managing a fund, a lot of your investors are in the Northeast area. We actually just went to a conference together up in LA, got to really meet in person, which was a lot of fun. Tell me your big takeaways and heading into 2022, and kind of your outlook and how you're positioning your fund to take advantage of what you see in 2022.
The key takeaway I think I took was inflation is here, and the real inflation is higher than the what's reported in the CPI, and especially on the asset side, just because there's still so much institutional money, so much private equity money looking for yield, because rates have been historically low for the last few years. Now, what that does to the sector, depending on what interest rates do, I'm not 100% sure, but we caught a good run the last few years in the value add multifamily space. We did amazingly well. I mean, we have properties that we closed on in late 2020, early 2021, where rents are up 40%, with a combination of value add and just increases in some of these hot markets. So, me personally, we over allocated to multi. We thought we were going to split between multi, storage, mobile homes, and industrial triple net. We thought we were going to have more of a diverse portfolio, and we ended up going 80% multifamily, and we absolutely crushed it. And we're going to continue with the value add multi, because it's I think especially in the workforce housing class, because I think it's going to continue to be a great hedge against inflation. But we are going to diversify a little bit more into some of the other asset classes, mostly for current cash flow. A lot of our investors are really cash flow driven first, and want that steady 6, 8, 10% without having to kind of wait the first year or two for the value add plan. So, we'll still continue to do value add, but we're pivoting a bit into property classes that can generate a little bit quicker current cash flow. And maybe we sacrifice a little bit of upside, but we've done well enough that we could afford to do that. And
What would some of those asset classes be then that would be focused more on the cash flow right now? Because it seems like everything we're looking at least in the main things you're looking at, we're still buying at a going in cap rate of anywhere between 3 and 5. Now maybe your stabilized is higher than that, but what are those asset classes?
yeah, I mean, we've seen a few storage deals pay that. The triple net lease type deals are a little bit more stable. Those are pre-negotiated, and again, you're sacrificing upside, but those generally have a more immediate cash flow.
Right.
And I personally have dabbled and are testing some other things that are kind of common in the syndication. Like I've done an ATM machine investment personally, just things for depreciation, and I've done a little bit of hard money lending. Hard money lending is used to be a business you can get 14%. But Wall Street has definitely invaded that asset class, and I think some rates are down to 7 or 8% for an experienced rehabber. That's challenging. But one of the other things I think one of the conference speakers mentioned it is, at this point in the market, in some cases it's okay to take a core plus asset or a class B asset that maybe doesn't need a full value add. If you're in a market that's really appreciating anyway, you don't maybe need to have as aggressive renovation plan. And, in some cases, maybe you renovate some of the units, but you don't renovate all of them, and your rents may still go up 20%. You don't bank on that in the model, but you may not need to be as aggressive with the value add plan immediately. Helps preserve positive cash flow and just less of a budget. And, that's some of the things we're thinking.
Well, not only that, I mean, you're still getting ridiculous offers at some of this stuff that still you got to go in and put 15, K or more per unit in to bring it up to value, where the reality is maybe just buy great assets, in great markets where rents are going to go, where there's still demand. I think that's a little bit of our strategy too, right? I mean, we've always been kind of value add real estate investors, but as the value add and there's so much capital kind of chasing everything, it's like we've kind of begin to think about, well, what if we just try and focus on quality assets, right? And to your point, maybe the yield is less upfront, but if things continue to go as they are, regardless of what you buy, I think you're going to want to hold on to quality assets. So it's an interesting kind of time that we're in. But I think you're right, man. In terms of inflation, what you don't want to be holding on to is cash.
Exactly. You just made me think of one other thing. Be creative. We're going to be involved in a hotel conversion. It was like a Town Suites Marriott brand that was a hotel that's vacant, which is going to be repurposed into a multifamily. So, a deal that's, it's not the cookie cutter multifamily value add. It's going to take a little more work, but it's also could be very, very lucrative. And then, we generally target, I've generally invested, as a, LP into deals that are above 100 units. That's typically where critical mass is for on-site property management. And they're institutional level deals where, at least on the exit, even once it's been cleaned up, you're going to do better. But we also did an 18 unit deal. And the reason we did was it was a condo. It's going to be a condo conversion, which condo conversions were big 20 years ago, kind of aren't talked about as much. But we have a deal in Cape Coral, Florida that was built as condos, but it was 2008. So it's been operated as a rental. As an 18 unit rental, it was kind of a boring property and, wasn't getting a ton of activity. However, we bought it in the low 200s per door, and we could sell those condo units for 340 to 360 per door. It's just one of those deals where people looked at it from the multifamily lens only and didn't really look at all the options. So value add could sometimes be just being creative and repurposing, repositioning. It's not always the traditional playbook.
100%, man. I always just was telling my partners this yesterday. We got some terms back from a lender. It's so interesting how many different products are out there for affordable housing, for example. And the rate reductions you can get for stuff like that. And I was just saying, the one who's going to win in this game right now is, I say there's 216 ways to skin a cat. He who knows the 217th way, is in this market as competitive it is going to win. And so you're so right, man. Finding ways to create value, and that doesn't just necessarily mean let's go in there and do a value add lift. It could be on the debt. It could be on the financing. It could be just like you said, maybe doing a condo conversion. So really, really smart, man. A couple of people, I guess your target in terms of you're a fund manager, you have a fund. I'm curious, those who are listening are going to be both active investors putting together deals, but also passive investors. So tell our audience a little bit about kind of who you're looking to connect with and really how to reach out to you.
Sure. So, the thing about our fund is most syndicators are going deal by deal, and we're there to partner with syndicators to be a consistent programmatic source of capital. And for our investors, I've talked to many investors, and this was the position I was in personally, is, if you only have a certain amount to allocate to the space and you have to choose any one deal, do you want to be in Houston? Do you want to be in Dallas? Do you want to be in Florida? And I wanted to create something that allowed people to be in everything. So we created a diversified fund. We're looking for passive investors that are looking for diversification and also to lean on our expertise, our connections, and our diligence of both the sponsors and the properties. We have investors that are also directly in syndications that just liked our model and liked the properties that came in. And we have a lot of just passive investors that are new to syndication that just want to diversify away from Wall Street. And the third component is we take a consultant approach. So being that I moved all the way to Puerto Rico for tax efficiencies, I love working with investors that are concerned about being tax efficient, and happy to just kind of look at their overall portfolio. I'm not a financial advisor. I don't have any of those certifications, but I've lived it myself. So I've had investors talk to one of the CPAs in my network and realize that their wife could be a real estate professional because she was already kind of there, and they actually qualified as a real estate professional. And if you're married filing jointly, you could be a surgeon making $2 million a year. If your wife is running your properties and qualifies as a professional, you can write off all of the K1 depreciation on any multifamily syndication you're in. So I've worked together with some of my investors to craft game plans. We've worked together on 1031s, which can't go into my fund, but if I have someone with a 1031, I can bring them to you and potentially put them directly into one of your projects. So I just love being kind of working as a team to figure out how we can create win-win solutions across the board.
Love that, man. Yeah. I mean, this is such a relationship game, and playing the long game really matters. How can folks get in touch with you, man? First, if they're in Puerto Rico or they're like, hey, I need a vacation, how do they get in touch with Jack Krupey so you can show them a good time, man? Let's start there.
Yeah, absolutely. So I'm on all social media. I'm on Facebook, I'm on LinkedIn, I'm on Instagram, and Instagram is just at J Krupey. We have the JCAM Investments is on all platforms as well. Our website is jcaminvestments.com, and we are in the process of launching a podcast. It'll be a couple months before it's out. Hopefully, I can have you on mine in the future. And really, encourage everybody to reach out, and happy to network, have a consultation, and help each other. Help the real estate's. I always say real estate's a team sport. So every connection is appreciated.
Jay, let's see. Jay, Jack, you have a Twitter. Let's see. He does have a Twitter. 247 followers, 248 now. And we're a big Twitter right here, man, group. So we need to get your I think this is you. We need to get your Twitter going.
Twitter's been lacking for me. I'm in a lot of Facebook groups, and Instagram's been a bigger focus, and we have a YouTube channel too. We haven't done podcasts, but we've done a number of educational webinars. So the YouTube channel is also something we're looking to grow. JCAM Investments on YouTube.
All right, we're gonna link some of this down in the show notes, guys. So make sure you get in touch with Jack. I've really enjoyed getting to know you. I'm excited about the things we're gonna do together in the future. Really just kind of fun. I mean, the fact that you picked up your life and moved to Puerto Rico just says like this guy's down. So I liked hanging out with you, dude. So appreciate you, man, and looking forward to doing some business together in the future, guys. Make sure you go follow Jay Krupey on Instagram, all over social media. Appreciate you, dude.
Great, thanks a lot.
See ya.